Imagine waking up, checking your exchange, and seeing the price of XRP at $15. But when you move your cursor to the buy button, it's grayed out. Insufficient liquidity. It is February 10th, 2026, and the fatal mistake of 95% of XRP holders has finally been realized. While you were waiting for a clean 5% dip to re-enter, a $500 billion liquidity drain was happening behind your back, orchestrated by people who don't even know your name. The door didn't just close. The locks were changed while you were staring at the RSI. Today, we don't talk about price targets. We talk about liquidity evaporation. We decode why buying the dip has become a destructive fantasy, and how the institutional supply shock is about to price out the retail world. The window isn't closing, it's gone. In the financial markets, price is what you see, but liquidity is what you actually own. The fatal mistake being made by 95% of XRP holders today is the assumption that the market will always be available to them. They are living in the correction delusion, convinced they can sell the top, wait calmly, and re-enter at the bottom as if nothing has changed. In 2026, this mindset is no longer just a mistake, it is self-destruction. When a digital asset transitions from a speculative toy to global financial infrastructure, the traditional rules of retail trading cease to exist. The evaporation of sell orders. Institutions do not buy like retail. They don't place small limit orders and wait. They absorb liquidity from the books faster than you can hit the buy button. The supply drain. Once central banks and major funds begin securing XRP for settlement rails, that supply leaves the exchanges permanently and enters cold vaults. Analysts note you are looking at RSI signals and support zones while institutions are looking at market depth and total absorption. The chart will not warn you when the exchanges are running empty. Look back at Bitcoin when it was under 1,000 and later under 10,000. Institutions publicly labeled it a bubble, while privately accumulating every available Satoshi. By the time retail investors realized the truth, the liquidity window had closed forever. You cannot buy Bitcoin for $100 today, not just because the price is high, but because the retail available supply at those levels was consumed by institutional infrastructure years ago. In February 2026, XRP does not move like an altcoin. It moves like a global settlement rail. The real buyers are not chasing a 5% scalp. They are corporate treasuries securing liquidity for cross-border operations. Institutional liquidity providers powering the ODL on-demand liquidity corridors, ETF desks automatically absorbing the daily circulating supply. These entities do not wait for a 10% pullback. They buy based on operational necessity. And necessity does not care about your emotions or your perfect entry. If you believe exchanges will continue to offer you XRP at retail prices while a new financial system is being built upon it, you fundamentally misunderstand how power and capital operate. Financial infrastructure transitions are quiet, boring, and invisible. The average retail investor is waiting for a grand announcement. A global press conference where world leaders tell the financial system to switch to XRP overnight. This is not how systemic shifts happen. By the time the public sees the front-end effect, the back-end infrastructure has already been running for months, if not years. The XRP supply shock of 2026 does not begin with news. It begins the moment institutions start testing, piloting, and routing real transactional volume through XRP rails without retail awareness. Consider the operational necessity. Banks cannot wait until the last minute to source liquidity. To route high-volume settlement flows, they must secure supply well in advance. They are running stress tests, modeling throughput, and ensuring they can move billions reliably across corridors like the U.S.-Mexico BITSO rail. This ramp-up phase is where the real accumulation happens, and it happens in silence. There is a profound misunderstanding regarding XRP's circulating supply. While billions exist, only a tiny fraction is truly liquid on exchanges. The rest is locked in escrow, controlled by long-term entities, or held in custodial vaults. When an institution with massive firepower steps in, they aren't competing with millions of casual traders. They are competing for a microscopic slice of available supply. A supply shock doesn't require every bank in the world to act at once. It only requires a handful of major players stepping into the same thin order book simultaneously. One of the most dangerous assumptions in retail is on-chain visibility. Retail believes that if institutions buy, the blockchain will make it obvious. OTC markets institutions source liquidity over the counter. They purchase through private arrangements, custodians, and brokers. Zero trace. These transactions leave no clear trace on exchange price action until the shock has already manifested. The delayed reaction. By the time the technical indicators show strength, the liquidity has already been drained from the exchanges. In a retail-driven market, dips form because of emotional panic selling. In an institutional market, the buyers are structured financial entities with multi-year plans. They do not liquidate on fear. They do not dump during corrections. They hold because they are building infrastructure. This means the usual cycles break down, dips become shallow, corrections become shorter, and the market floor moves higher permanently. You are waiting for a dip that is being systematically bought out before it even reaches your screen. In a liquid market, everyone is invited. In a systemic market, access is a privilege reserved for the positioned. We must address the psychological and structural shift that occurs once the XRP supply shock fully takes hold. Most retail investors assume the future will look like today. Exchanges available 24/7, order books full, and XRP always waiting for them. This is the final delusion. When liquidity evaporates, the friendly tools you rely on will fail you. The limit order failure. You may set a limit order at a specific price, but if the market is leapfrogging levels due to a lack of supply, your order will simply be skipped. Brutal slippage. In a thin market, a relatively small buy order can move the price 5% or 10% against you instantly. The clean entry you practice for years becomes a structural impossibility. History shows us that when an asset becomes scarce, the official chart price and the actual acquisition price begin to decouple. During previous Bitcoin supply squeezes, regional premiums reached 40% to 80% over the global spot price. If XRP follows this institutional path, you may see a price of $10 on your screen, but find that to actually obtain the asset, you must pay a massive premium to whoever still holds liquid supply. Liquidity becomes the primary factor. Price becomes secondary. The most painful consequence for the wait-and-see crowd is the permanent narrative shift. Once institutions are the primary holders, the media coverage will flip overnight. The old story, XRP as a speculative coin or retail pump. The new reality, XRP as a core financial tool and systemic settlement rail. When this narrative solidifies, the analyst estimates and liquidity models will adjust to institutional valuations. Retail investors will no longer dictate the price. They will become mere spectators, watching a global infrastructure layer operate far beyond their reach. I must be clinical about this. Holding on centralized exchanges during a liquidity event is a high-risk strategy. If there is a supply shock or an institutional drain, exchanges may temporarily halt withdrawals or freeze trading to protect their own solvency. As we saw with the FTX event, those who did not practice self-custody learn the truth too late in 2026. Your keys are your only ticket to the new financial order. The door doesn't close with a bang. It closes with a silent turn of the key. The transition from a retail market to a global infrastructure layer is the final act of the XRP story. As we have decoded today, the greatest risk to your position is not a temporary price correction, but a permanent structural displacement. The XRP supply shock of 2026 is a repricing event that technical analysis cannot predict and that retail emotions cannot survive. Once the liquidity window closes, it does not reopen. Institutions do not buy to sell back to you at a lower price. They buy to secure the rails of the future financial order. Do not be the spectator who watches the charts and waits for a perfect entry that no longer exists. Be the participant who understands that utility necessity outbids speculation every single time. The door is turning. The locks are changing. Stay patient. Stay rational. We don't wait for the future. We plan for it.